Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're really immersing ourselves in, well, the pretty dizzying world of day trading. High speed, often misunderstood. And for so many people, the attraction is just, it's pure lifestyle, isn't it? You know, the freedom, trade from anywhere, maybe make $500, $1,000 a day.
Right. Set your own rules.
Exactly. It sounds like total financial autonomy.
Yeah.
The ultimate self-starter dream job.
It really does sound like the ultimate brass ring, yeah.
Right.
But we absolutely have to kick off this deep dive with let's say, a firm reality check based on everything we looked at.
Okay.
Rule number one, and this is kind of immutable, day trading is fundamentally not a get-rich-quick scheme. Just isn't.
Right.
So if anyone's selling you that idea, you need to be extremely skeptical, really skeptical.
Well, that data backs that up, doesn't it?
Right.
We looked at some actual court records, financial brokers in Massachusetts.
Yeah.
And the stats are, well, they're pretty brutal.
They are.
After just 6 months, only about, 16%? 60% of day traders actually made any money.
Which means an 84% failure rate.
Yeah, 84%. And if you compare that, like you said, to starting a regular business, it's almost identical. That notoriously high failure rate for new companies.
And that parallel, I think that's the key insight, actually. People jump into a business thinking, oh, easy money. And, they fail. People jump into trading with the exact same mindset, and guess what? They fail.
So this leads us right to rule 2 then.
Directly. Rule 2. You absolutely must treat day trading as a serious business, a profession.
Okay.
I mean, think about it. You wouldn't expect to walk into a 6-figure job as a lawyer or maybe an engineer without years of school, right? Specialized training, exams.
Right, of course not.
So why on earth would trading be any different? It requires that same level of study, preparation, practice.
So we're really talking years. Years of commitment, study, just to get to a point where you might reliably earn that kind of income people dream about. The $120K, $240K a year successful traders hit.
Absolutely. It's a job, a very demanding job, not a lottery ticket.
Okay, so if it's this serious profession, let's nail down the definition. What is day trading, precisely?
Well, it's strictly an intraday discipline. That's the core of it.
Intraday, meaning?
The position is opened and it's closed before the market shuts down for the evening, period. The second you decide to hold a position overnight, boom, you've crossed the line. You're swing trading now.
And that's different.
Fundamentally different. It's a different business model, requires totally different strategies, different risk management. Day traders operate on, seconds, minutes, maybe half an hour sometimes, but rarely longer than that.
So the focus is super short term, micro movements. You're not worrying about Microsoft's 5-year plan.
Exactly. You couldn't care less about Microsoft's long-term fundamentals, actually.
You're just looking at the chart, maybe between 10:30 a.m. and 10:435 a.m.
Precisely that. Traders obsess over those tiny price fluctuations. Technical analysis, pure price action. They completely ignore things like quarterly earnings reports, PE ratios, all that stuff long-term investors care about. A trader's skill is spotting which stocks have the technical momentum, or maybe the weakness, to give them a profitable entry and exit today, right now.
Okay, makes sense. Let's get into the mechanics then. How do you actually pull profit out of these short-term moves? A trader needs to make money if the price goes up or down, right?
That's crucial, yeah. You need to master both sides, buying long and selling short.
Buying long feels intuitive. You buy shares, hope the price goes up, you sell higher. Simple enough.
Pretty straightforward, yeah.
But explain the other side, the maybe more complex and you hinted more dangerous direction, selling short.
Right. Short selling is basically the inverse bet. You're betting the price will go down.
Okay.
So you borrow shares from your broker, let's say 1,000 shares of some stock trading at $50.
Right.
You immediately sell those borrowed shares on the open market. That puts $50,000 cash in your account temporarily.
Okay, I borrowed them, sold them, now what?
Now you wait and you hope the price drops. If that stock falls to, say, $45.
And I buy them back.
Exactly. You buy back the 1,000 shares for $45,000. You return those shares to the broker you borrowed them from, and you pocket the difference.
Which is $5,000 in this case.
$5,000 profit. That's short selling.
That sounds, well, really attractive. Especially when the market's tanking, right?
Right.
Because fear drives prices down fast. Stocks seem to fall way quicker than they climb.
They often do, yeah. Fear is a powerful motivator in markets, but, and this is a huge but, the risk profile is dramatically different and much, much scarier.
How so?
Well, When you go long, when you buy shares,
Mm.
what's the worst that can happen?
My stock goes to zero. I lose everything I put in.
Exactly. Your maximum loss is capped at your initial investment. It can't go below zero.
Okay.
When you sell short, your loss potential is theoretically unlimited.
Unlimited.
Think about it. You shorted at $50. What if some crazy good news hits, buyout, whatever? The stock doesn't drop, it surges to $100, maybe $200, maybe even $500 in a short squeeze. You still owe the broker those 1,000 shares you borrowed. You are forced to buy them back at that much higher price, that catastrophic price.
So instead of making $5,000, I could lose $50,000 or $150,000
Yeah.
or more.
Easily. That's how trading accounts get completely wiped out. Instantly sometimes.
Wow. Okay. That's sobering.
And there's more. If you hold that short position overnight, guess what?
Let me guess. Fees.
Yep. Your broker charges you interest for borrowing those shares. It's called the cost to borrow. Unless you cover the short the same day, it adds up.
So short selling really sounds like it's only for like really experienced traders, people who truly understand how to manage that potentially infinite risk.
It absolutely is. It's not a tool for beginners, generally speaking.
And speaking of risk,
Yeah.
as retail traders, just regular folks trading from home, who are we actually up against in these trades, whether we're long or short?
Yeah, that's a good question. You're stepping into the ring with titans.
Titans. Like, ooh.
Massive investment banks, hedge funds with billions under management. And maybe most importantly, they're automated, ultra-fast computer programs, high-frequency trading algorithms, HFT.
Okay, that sounds completely overwhelming.
Mm.
How does a little guy, a lone trader like me, even stand a chance?
Mhm.
How do I avoid getting instantly steamrolled by these giants with better tech, faster data, basically infinite money?
Well, look, you have to accept reality first. You will never outspend them. You will never outspeed their algorithms. That's just a fact.
So game over.
No, not at all. The sources we looked at often use this analogy of guerrilla warfare.
Guerrilla warfare
Right.
against hedge funds.
Kind of, yeah. Your size, your smallness is actually your biggest advantage. Think about it. Those big institutional traders, they have to move enormous volumes, millions of shares sometimes.
Right.
It takes some time, multiple transactions to build a position, and critically, it takes them time to get out of a position without moving the market against themselves. They lack mobility. They're like big, slow tanks.
So they're the tank.
The retail trader is the agile skirmisher, the guerrilla fighter.
I see. Hit and run.
Exactly. You use hit-and-run tactics, you wait patiently, you look for those perfect high-probability moments. You only need to trade a few hundred shares, maybe a couple thousand. Keep your risk tiny.
So my goal isn't to beat Goldman Sachs' entire strategy for the day.
No way. Your goal is just to skim a few cents, maybe 10 cents, 20 cents, off a quick move that they might be initiating or reacting to. You hit your small daily profit target, and you get out. You live to fight another day.
Okay, that makes more sense. You mentioned the HFT algorithms. If I can't beat them on speed, I guess I have to be smarter. Can you give an example of how a retail trader might actually identify or even use the predictable behavior of an algorithm?
Yeah, there are patterns. A classic one is sometimes called the buy the new low algorithm.
By the new low, what does it do?
It's a program designed to automatically place buy orders every single time a stock hits a new intraday low price.
Why would it do that?
The idea is to bet against retail short sellers. The algorithm assumes that when a new low is hit, scared short sellers will panic and cover their positions, meaning they buy back shares. This buying pressure, combined with the algorithm's buying, is supposed to push the price back up. And it often works, because these algorithms have deep pockets.
Okay, but where does it fail? When can I, the guerrilla fighter, take advantage?
It fails spectacularly when it runs into real, heavy, institutional selling pressure. Imagine a massive hedge fund decides, for whatever reason, to dump 500,000 shares of that same stock right at the moment the little algorithm is trying to buy the new low.
The algorithm gets overwhelmed.
Completely overwhelmed. The price doesn't bounce. It just keeps crashing right through the algorithm's buy orders. A smart day trader, watching the order flow, watching level 2 data, they can see this huge selling volume hitting the bids. They recognize the algorithm is failing, and they can jump on board the short side, riding that wave down with the big institution.
So you're kind of piggybacking on the bigger player who's crushing the algorithm.
Yeah, precisely. We saw tons of this during the 2008 crisis, for example. Algorithms desperately trying to buy the dip on collapsing bank stocks, just getting obliterated by the sheer force of fundamental selling. So you have to learn to read the tape, read the order flow, and that practice, It really requires moving into the absolute core foundation of this whole profession discipline.
That's a perfect segue. If trading is this serious profession, it needs structure. The sources often talk about success resting on like a three-legged stool. Can you tell us about those three legs?
Yeah, it's a great analogy. To succeed long-term, you absolutely have to master three distinct skills all at the same time.
Okay, what are they?
1, proven, tested trading strategies. You need an edge. 2, proper, rigorous risk management, non-negotiable. And 3, sound psychology and emotional control.
Strategies, risk management, psychology.
Right. And if any one of those three legs is weak or broken, the whole stool collapses. Your trading career is over.
And which leg is most important? Or keeps you in the game longest?
Oh, without a doubt, it's risk management. That's the leg that keeps you alive long enough to actually master the strategies and get your emotions under control. You can have the best strategy in the world, but if you risk too much on one trade, you're done.
Okay, let's drill down hard on that then.
Yeah.
The absolute bedrock principle of survival, the one every pro trader seems to agree on. The 2% rule.
The 2% rule, yeah, this is your golden rule, your lifeline. It simply dictates that you must never, ever risk more than 2% of your total trading account capital on any single trade.
Never more than 2%.
Never. And honestly, most really conservative, successful traders, they aim for 1%, or even less sometimes.
Why is that so critical?
Because it mathematically prevents any single mistake, any one bad trade from causing catastrophic damage to your account. It ensures your survival.
In this calculation, the 1% or 2%,
Yeah.
you have to do it before you even place the order, right?
Absolutely. Before you click buy or sell, it determines your position size. Let's walk through that example with the $40,000 account. 3 steps.
Okay, step 1.
Step 1. Define your maximum dollar risk for this specific trade. So on a $40,000 account, 2% is $800. But let's be conservative, let's use 1%.
Okay, 1% of 40K is $400.
Right. So $400 is the absolute maximum amount of cash you are allowed to lose on this trade if it goes against you. That's your line in the sand.
Got it. $400 max loss. Step 2.
Step 2. Define your maximum risk per share. This is based on your strategy and your stop-loss placement. Where does the chart tell you your trade idea is definitively wrong?
Okay, so let's say my strategy says buy at $100. And the clear point where I know I'm wrong, the support level below is at $99.60.
Perfect. So your entry is $100. Your stop-loss is $99.60. The difference, the risk per share, is $0.40 or 40 cents.
Okay, 40 cents risk per share. Now step 3.
Step 3, calculate your maximum allowed share size. You simply take your maximum dollar risk from step 1.
Which was $400.
And you divide it by your maximum risk per share from step 2.
Which was $400 divided by 40 cents. That's 1,000 shares.
Exactly. 1,000 shares is your maximum position size for this trade. Doesn't matter how amazing you think the setup is, how confident you feel. You are forbidden by your own rules from trading 1,001 shares.
Because that would mean risking more than the $400, more than 1% of my capital.
Precisely. This calculation locks in your potential loss before you even enter. It means even if you're wrong, say, 5 times in a row, which happens,
Yeah.
you've only lost 5% of your capital, you haven't destroyed your account, you can still trade tomorrow. That's survival.
Okay, that's the defense. Absolutely crucial. Now let's talk offense. Rule 5 in the sources focused on selecting the right opportunities, finding low-risk entries that have high potential rewards.
Yes, absolutely. Risk management tells you how much to risk. Opportunity selection tells you when to risk it. We need setups where the potential gain significantly outweighs that calculated risk.
So what's the minimum acceptable ratio?
The generally accepted minimum reward to risk ratio is 2 to 1.
2 to 1, meaning?
Meaning, if you're risking that $100 or $400 in our example, you need to have a realistic chart-based expectation of making at least $200 or $800 if the trade works out.
So double your risk.
At a minimum.
Yeah.
Honestly, the best setups, the A-plus trades that professional traders learn to wait patiently for, maybe for hours. They often offer ratios of 3 to 1, 5 to 1, even higher sometimes.
Risking $1 to potentially make 5.
That's a good setup. That's where your edge comes from. If you look at a potential trade and you figure, okay, I'm risking $100, but the chart suggests I can probably only make $50 or maybe $100.
Skip it. Absolutely skip it immediately. It's just not worth the risk. Your long-term profitability hinges on finding and taking only those trades with a positive mathematical expectancy. That means a good reward to risk ratio.
And sticking to that calculated risk, that $0 for 40 cents per share in our example, leads directly to maybe the most painful but also the most vital psychological hurdle, the stop loss itself.
Yeah, stop loss, yeah.
It's that line in the sand we calculated. It must be defined before the trade, and it must be honored. No exceptions. What happens when traders ignore it when they start hoping.
Oh, that's where the psychology leg of that three-legged stool just crumbles instantly.
Yeah.
And it's incredibly common, especially for beginners.
We saw that sobering example, didn't we? The veteran trader trading American Airlines, AAL, back in 2020 during the pandemic crash.
Yeah, that was a tough story, but a really important one. This trader, experienced, went into the trade without a predetermined stop loss. Why?
Because they were convinced, fundamentally, that the stock had dropped so much it had to bounce back eventually.
Exactly. The narrative they were telling themselves was, look, the government's going to bail out the airlines. This is an obvious bottom. It has to go up from here. They weren't trading the chart in front of them. They were trading their belief, their hope.
And the price
Yeah.
didn't cooperate.
The price just kept plummeting. They entered the trade initially risking maybe around $1,000 based on their usual size. But because they didn't have that hard stop, they just held on, hoping, praying.
And the loss just grew.
And grew and grew. By the time they finally couldn't take the pain anymore and capitulated, just hit the sell button, they'd lost a gut-wrenching $25,000 on a single trade that should have been maybe a $1,000 loss.
Wow, 25 grand, just evaporated by wishful thinking.
The lesson there is just crystal clear. Your job as a trader is not to predict what a stock should do. Your job is to react unemotionally to what the stock is doing right now based on your predefined plan.
So successful traders, they're okay with being wrong often.
They're more than okay with it. They expect it. They're sometimes called really good losers.
Good losers. That sounds weird.
It means they've mastered the art of taking small, quick, painless losses, that 30 cents, 40 cents per share we talked about. As soon as the price hits their stop loss, invalidating their trade idea, they're out. No hesitation, no emotion, just execute the plan. Small loss, reset, find the next setup.
But how do you actually do that? How do you conquer that incredibly powerful human urge to hold on just a little longer? The desire to be proven right.
Well, part of it comes back to that 1% or 2% rule we hammered on. That rule is your emotional shield.
How so?
If you know, truly know, that hitting your stop loss is only going to cost you 1% of your total capital, it becomes mathematically insignificant. It's just a small cost of doing business. You accept it.
So it doesn't feel like a disaster.
Exactly. The panic, the fear, the hope, that really only sets in when you haven't managed your risk properly. When you're risking 10%, 20%, maybe even 50% of your account on one single position because you didn't calculate size correctly, then hitting the stop loss feels catastrophic. And that's when people freeze or double down.
Okay, so if ignoring the stop loss out of stubbornness leads to big losses like the AAL trade, what's the ultimate account-killing mistake, the one that just wipes people out completely?
The big one, averaging down.
Averaging down. Explain that.
Averaging down is the classic beginner's trap. It means when a position is losing money, instead of cutting the loss, you buy more shares at the lower price.
Why would anyone do that?
The thinking is it lowers your average entry price. So if you bought at $50, it drops to $45, you buy more. Now, your average cost might be, say, $47.50. The idea is the stock doesn't have to recover as much for you to break even or make a small profit.
And does it work?
Here's the insidious part. Mathematically, averaging down does work. About 85% of the time, the stock often does bounce back a bit, letting you get out near break even.
So, why is it so bad then, if it works most of the time?
Because the other 15% of the time, when times it doesn't work, when the stock just keeps falling and falling, those losses will be so catastrophic they wipe out all the small wins from the previous 85 times and potentially your entire account along with it.
It's literally sending good money after bad, isn't it? Trying to rescue a losing trade instead of just cutting it?
Precisely. You're violating your stop loss rule. You're violating your position sizing rule. You're basically throwing your entire trading plan out the window based on hope.
The sources gave a really stark, large-scale example of this, didn't they? Brian Hunter at Amaranth Advisors back in 2006.
Yeah, the Amaranth blow-up. A truly spectacular failure driven by averaging down. This guy, Brian Hunter, he was a superstar energy trader, managing like $10 billion in assets.
$10 billion.
And he averaged down.
Massively. He became completely emotionally committed to his huge bullish bets on natural gas prices. When the price started to tank unexpectedly, instead of cutting his losses like any sane risk manager would,
he doubled down.
He doubled down, tripled down. He kept averaging down, making his position bigger and bigger and bigger as the price fell further. He was absolutely convinced, based on his analysis, that the price had to rebound eventually.
But it didn't soon enough. It didn't. The losses became so enormous that his brokers, led by JP Morgan, forced him to liquidate the positions at the worst possible time, locking in the losses. The fund lost something like $6.6 billion in about a week.
$6.6 billion gone.
Gone. And the entire hedge fund collapsed shortly after. All because of pride, stubbornness, and the refusal to admit he was wrong, the core reasons people averaged down.
Wow. And the irony, wasn't it, that natural gas prices did actually rebound significantly just a few weeks later? He was fundamentally right, eventually.
He was. That's the tragedy of it. Being right eventually means absolutely nothing in trading if you run out of capital before the market validates your view. Hunter's failure is the ultimate proof.
Yeah.
Even with $10 billion, the mistake of averaging down is simply too dangerous to survive.
So for us retail traders, with maybe 30K or 50K, we have zero chance of surviving that kind of drawdown.
Zero. You simply cannot tolerate it. And this realization that emotional discipline is probably the biggest bottleneck for most traders. That needs to transition into making sure you have the right technical tools, the tools you need to actually execute that discipline effectively.
Okay, good pivot. Let's move from the psychological pitfalls to the actual nuts and bolts, the tools and platforms needed for this high-speed game. If I decide, okay, I'm committed, I'm going to treat this seriously, I can't just use my standard brokerage app on my phone, can I?
Oh, absolutely not. No way. Those conventional full-service brokers or even the basic apps, they're designed for investors. They prioritize research, maybe fancy reports, but their order execution is often slow, multi-step, totally unsuitable for day trading.
So what do day traders need instead?
You need what's called a direct access broker. These firms are built for speed.
Direct access.
Yeah, they focus almost exclusively on providing fast, reliable, flawless order execution with minimal slippage. That's the difference between the price you expect and the price you actually get filled at. They often route your order directly to the major exchanges or electronic communication networks, ECNs, bypassing intermediaries.
And that speed is critical because
in day trading, especially with volatile stocks, the difference between a profitable trade and a losing trade can literally be measured in milliseconds. A fraction of a second delay can cost you real money. Speed is absolutely non-negotiable.
Okay, direct access broker for speed. Got it. Now, the elephant in the room for a lot of aspiring traders, especially in the U.S., the pattern day trade rule. The PDT rule.
Yes, the PDT rule. It's a big hurdle for many. It's enforced by the SEC and Faminara, the regulators.
And what does it say exactly?
Basically, it states that if your account makes 4 or more day trades, that's buying and selling the same security within the same day, within any rolling 5 business day period.
Okay, 4 trades in 5 days.
Then your account is flagged as a pattern day trader. And to continue day trading, you must maintain a minimum account equity of $25,000. 25 grand.
Ouch. $25,000 minimum. What happens if my account drops below that? Say I have a bad week and it dips to $24,000.
You're locked out. Your broker is required to restrict your account from making any more day trades until you deposit enough funds to get back above the $25,000 threshold. Usually you get one warning or reset, but repeated violations mean a 90-day trading restriction.
That's a pretty significant capital requirement, especially for someone just starting out.
It absolutely is. And while it feels restrictive, the regulators argue its purpose is actually to protect amateur traders, to prevent people with small accounts from blowing them up really quickly using too much leverage, which we'll get to.
Okay, so given that 25-day K barrier, it's not surprising we see the rise of offshore brokers.
Right. Companies advertising that they let you trade without worrying about the PDT rule, like Capital Markets Elite Group, CMEG is one name you hear. Exactly. These brokers are based outside the U.S., often in the Caribbean or elsewhere, so they aren't subject to FINRA's PD2 rule. They allow traders to start with much smaller accounts, maybe $500 or $1,000.
And they often offer high leverage too, don't they?
They do, sometimes as high as 6-to-1 leverage. Which means, you know, a $5,000 deposit could give you $30,000 in buying power. That's very attractive to undercapitalized traders.
But what's the catch? There's always a catch, right?
The big catch is regulation, or rather the lack of it. These offshore firms operate outside the protection of U.S. regulatory bodies like the SEC and SIPC insurance.
So if something goes wrong, if there's a dispute, or the broker goes bust.
Your recourse, your legal options are far more limited, maybe even non-existent, compared to using a regulated U.S. broker like Interactive Brokers or Charles Schwab. You're essentially trading regulatory security for lower capital requirements and higher leverage. It's a significant risk trade-off.
Okay, that's important to understand. What about the platforms that really shook things up a few years ago, the commission-free brokers like Robinhood? Are they any good for serious, active day trading?
Well, look, they were revolutionary in driving down trading costs to zero, which was huge. But for the demands of active, fast-paced day trading, generally, no, they're not considered suitable by most serious traders.
Why not? Free trades sound good.
Reliability and speed under pressure. When you're trying to execute trades in seconds during moments of extreme market volatility, that's precisely when you need your platform to be rock solid.
And Robinhood.
Robinhood and some similar platforms have unfortunately had multiple instances where their systems crashed or became unresponsive during major market events, exactly when traders needed access the most. People were locked out, unable to sell losing positions, unable to take profits on winning ones. That's just unacceptable for a day trader.
So paying a small commission for a reliable, fast, direct access platform is probably worth it.
For serious day trading, yes, reliability is paramount.
Okay, you mentioned leverage with the offshore brokers, that 6-to-1 buying power. Let's quickly touch on margin, because that's the mechanism behind leverage, right?
Exactly. Margin is leverage. It's essentially borrowing money from your broker, using the securities in your account as collateral to control a larger position size than your cash balance would allow.
Like getting a mortgage to buy a house that's worth more than your down payment.
Perfect analogy. Margin allows you to potentially amplify your returns. If you control $30,000 worth of stock with only $5,000 cash and the stock goes up 10%, you make $3,000 on your $5,000, a 60% return, instead of just $500.
This is great. But
it's a double-edged sword. It amplifies losses just as dramatically. If that stock goes down 10%, you lose $3,000 on your $5,000 capital. That's a 60% loss. It magnifies risk enormously.
when if the losses keep mounting, what's a margin call?
A margin call is serious trouble. It's a demand from your broker to deposit more cash into your account immediately. It typically happens when your losses pile up to the point where your account equity falls below the broker's required maintenance margin level, meaning your losses are eating into the borrowed funds.
And if I can't deposit more cash,
The broker has the right to forcibly liquidate your positions, sell your stocks at the current market price, whether you like it or not, to cover the money you owe them. Margin calls can wipe accounts out very quickly if you're over-leveraged, so using margin conservatively, if at all, is key.
okay, really important warnings there. Now, let's get back to execution speed. You need a direct access broker. But the trading platform itself, the software you use like Dash Trader or Sterling Trader Pro, that's often separate from the broker, right?
Yes, often they are separate. You might use Interactive Brokers as your broker for clearing trades and holding funds, but use Dash Trader Pro as your front-end platform for charting and order entry because of its speed and features.
And the absolute core skill for using these platforms at high speed is hotkeys.
Hotkeys, absolutely non-negotiable. Mandatory for serious day trading.
Why are they so crucial? Why can't I just use the mouse?
Because time is money. Literally, down to the millisecond.
Yeah.
Trying to trade a fast-moving, volatile stock by clicking the buy button, then typing in the share quantity, then selecting the order type, then confirming the price, that takes maybe 2, 3, 4 seconds.
Yeah, sounds about right.
In day trading, 4 seconds is an eternity. The price could move significantly against you in that time, costing you slippage or missing the entry entirely. Hotkeys eliminate all of that fumbling.
So what is a hotkey exactly?
It's a pre-programmed command linked to a specific key or key combination on your keyboard. You set them up in your trading platform.
Give me an example.
Okay, let's say you want to instantly sell your entire current position at the best available price, but protect yourself slightly. You might program the F1 key to execute this command. Sell all shares at limit bid 0.05.
Okay, break that down. Sell all shares.
Means liquidate whatever number of shares you're currently holding of that stock.
At limit bid 0.05.
Means send a limit order to sell, but set the limit price 5 cents below the current highest bid price. This almost guarantees an immediate fill because you're willing to take slightly less than the best bid, while still putting a safety net. It won't sell for more than 5 cents below the bid, protecting you from a sudden price drop during execution.
And hitting F1 does all that instantly.
Instantly. One keystroke, no mouse clicks, no typing numbers. Buy orders, sell orders, order modifications, canceling orders, everything is done via hotkeys for maximum speed and efficiency.
That precision leads us nicely into order types. We need to get these right too. You mentioned limit orders. There are also market orders and something called marketable limit orders. What's the difference, and which one do day traders typically use with their hotkeys?
Good question. 3 main types. First, market orders. These are the simplest. Buy me shares or sell my shares right now at whatever the best available price is. Just get me in or out immediately.
Sounds fast. Why not use those?
Because it's like writing a blank check in a fast market. You have no price protection. You might click buy thinking the price is $50, but in the split second it takes to execute, the best offer jumps to $50.50. You get filled at $50.50, instantly losing 50 cents per share to slippage. Very risky and volatile stocks.
Okay, so market orders are generally discouraged. What about limit orders?
Limit orders give you price control. You specify the exact price you're willing to pay for a buy or accept for a sell, or better. For example, buy 500 shares, but only if I can get them at $50.10 or lower.
That sounds safer. Any downside?
The downside is your order might not get filled, or only partially filled, if the price moves away from your limit before your order can execute. For really fast momentum trades, waiting for a limit order might mean missing the move entirely. Swing traders often use limit orders, but day traders need speed.
So if market orders are too risky and limit orders might be too slow, what's the solution?
The solution, and the preferred method for most active day traders using hotkeys, is the marketable limit order.
Marketable limit order. How does that work?
It cleverly combines the speed of a market order with the safety of a limit order. Your hotkey sends a limit order, but sets the limit price slightly aggressively, maybe a few cents above the current asking price for a buy, or a few cents below the current bid price for a sell, like our F1 example.
Why do that?
Because setting the limit slightly through the current best price makes it marketable. It guarantees an immediate fill, just like a market order. But critically, it still has that limit price attached as a ceiling for buys or floor for sells. It protects you from disastrous slippage if the market suddenly gaps against you during execution. It's the best of both worlds for speed and safety.
Okay, that makes a lot of sense. Marketable limit orders via hotkeys. Now, to make these super fast decisions, traders need the best possible real-time view of the market supply and demand. That brings us to level 2 data. Why is level 2 considered absolutely mandatory, and how is it different from just looking at a price chart?
Level 2 is indispensable. It's fundamentally different from charts because charts are lagging indicators. Yeah, a chart, moving averages, technical indicators, they're all calculated based on prices where trades have already happened. They show you the past. Level 2, on the other hand, is a leading indicator. It shows you the intention of buyers and sellers before the trades actually execute.
How does it show intention? What am I actually seeing on level 2 screen?
You're seeing the order book. It displays the best bid prices, the highest prices buyers are currently willing to pay, and the best ask prices, the lowest prices sellers are currently demanding, along with the number of shares being offered at those prices by different market participants, market makers, ECNs, sometimes institutions.
Give me that analogy you used earlier. If a chart is the past performance report.
Level 2 is like standing in the stadium box office before the game and actually watching the lines form for tickets. You can see right now there are 10 people lined up trying to buy tickets at $50, the bids, and only 2 people trying to sell tickets at $51, the asks.
So you see an imbalance.
Huh?
More buyers than sellers right now.
Exactly. That imbalance suggests demand is outweighing supply at current prices, and the price is likely about to move up towards $51 or maybe even higher as those buyers compete. If you were only looking at a chart, the lagging indicator, you'd only see the price move after those 10 buyers actually bought their tickets. Level 2 gives you that crucial heads up.
And level 2 also shows us the bid-ask spread, right?
Mm-hmm.
The difference between the highest bid and the lowest ask.
Yes, and the spread is critical. It tells you about the stock's liquidity.
How so?
A narrow spread, maybe just 1 or 2 cents difference between the bid and ask, means the stock is highly liquid. Lots of buyers and sellers packed closely together. It's easy to get in and out quickly without your order significantly impacting the price. That's good.
And a wide spread, like 15 or 20 cents?
A wide spread signals low liquidity or illiquidity. Fewer participants, bigger gaps between buyers and sellers. This is risky for day traders. It's harder to get filled, slippage is more likely, and trying to buy or sell even a moderate number of shares could dramatically move the price against you. Reading the spread and also the size of the bids and asks, are there big orders waiting, is crucial for anticipating short-term moves and managing entry-exit risk.
Okay, understanding liquidity is key, which brings us to the next big challenge, actually finding the right stocks to trade each day. Out of thousands of stocks, how do you narrow it down? Rule 7 in the material says we must only trade stocks in play. What makes a stock in play?
A stock in play is basically one that's moving significantly and, more importantly, moving independently of the overall market trend for that day. It has its own story going on.
And what creates that independent movement?
Usually a specific fundamental catalyst, some kind of unexpected news that grabs attention.
Like what kind of news?
Could be anything, really. A company releases much better or worse than expected earnings. A biotech firm gets FDA approval or rejection for a new drug. News of a merger or acquisition breaks. A big contract win. Something specific to that company that makes traders suddenly interested in it, regardless of whether the S&P 500 is up or down.
So if the overall market is flat, but Apple suddenly jumps 3% because they announced a new product, Apple is in play that day because of its catalyst.
Exactly. That catalyst creates unusual interest and, crucially, unusual volume. And that brings us to the main technical indicator we look for to confirm a stock is in play: high relative volume.
High relative volume. What does relative mean here?
It means comparing today's trading volume right now to the stock's average trading volume for the same time of day, usually based on the last 30 or 90 days.
Okay, so if a stock normally trades, say, 500,000 shares by lunchtime.
But today, by lunchtime, it's already traded 5 million shares.
Whoa.
That's high relative volume, 10 times normal in this case. That tells you there's immense, unusual interest in the stock today, likely from retail traders, fast money, maybe institutions reacting to that catalyst. That high volume provides the liquidity and volatility needed for day trading strategies to work.
And if a stock has just average, normal volume?
Stay away. Generally, stocks trading on normal volume are dominated by those HFT algorithms just trading tiny spreads back and forth. There's usually not enough clean directional movement for a retail day trader to easily profit. You need that unusual activity. Trade the best, leave the rest.
Makes sense. Another critical filter the sources mentioned for choosing stocks is the float, the number of shares actually available for public trading. How does float affect things?
Float is hugely important because it directly dictates a stock's potential volatility. It's basic supply and demand. Fewer shares available, low float, means it takes less buying or selling pressure to move the price significantly.
So we can categorize stocks by their float.
Yeah, typically into 3 broad categories, and each behaves very differently. First, you have low float stocks. These usually have fewer than, say, 20 million shares in their public float. They're often lower price stocks, maybe under $10 or $20.
And because the supply is so limited?
Any sudden surge in demand, maybe driven by news or promotion, can send these things absolutely parabolic. We're talking potential moves of 100%, 500%, even 1,000% or more in a single day. Extremely volatile.
Sounds exciting, but also risky.
Extremely risky. High reward potential, but also high potential for manipulation and sudden collapses. These are generally best suited only for very experienced, aggressive traders who understand the dynamics. Definitely not for beginners.
Okay, so low float, high volatility, high risk. What's next?
Medium float stocks. This is a broader category, maybe ranging from 20 million shares up to around 500 million shares. Prices here are often in the $10 to $100 range.
And
This is often considered the sweet spot for many standard day trading strategies. They have enough volatility to provide decent trading ranges, but the moves are generally more structured, more predictable than the crazy low floaters.
So this is where strategies based on technical levels like support and resistance or indicators like VWAP, volume weighted average price, tend to work more reliably.
Exactly. The movement is active, but usually less prone to those insane spikes and crashes. It's where a lot of professional day traders focus their efforts.
And the last category.
Large float stocks. These are the behemoths, typically with over 500 million shares in the float. Think Apple, Microsoft, the big banks, mega cap companies.
And how do they trade?
They tend to be much less volatile on an intraday percentage basis. It takes colossal buying or selling pressure, billions of dollars, to move their prices significantly. So while they might be in play on major news, most retail day traders tend to avoid them simply because the daily ranges are often too small relative to the risk, and they're heavily dominated by institutional order flow.
Okay, so filter by catalyst, check for high relative volume, and consider the float category. Now, how does a trader actually find these potential candidates each morning before the market opens or even during the day?
2 main tools or processes for building that daily watch list. First is scanning for pre-market gappers. Before the market opens at 9:30 a.m. Eastern, traders run scanners looking for stocks that are already showing a significant price gap, either up or down, compared to yesterday's close, maybe more than 2% or 3%.
And these gaps are usually caused by that
That fundamental catalyst we talked about, earnings released overnight, news breaking before the bell. The trader then investigates why it's gapping, checks the pre-market volume to see if the interest is real, looks at the float, and identifies key levels. From maybe dozens of gappers, they'll narrow it down to just 3 or 4 prime candidates to watch closely right at the opening bell.
So that's the pre-market prep. What about finding opportunities during the trading day?
For that, you use real-time intraday scanners. These are software tools constantly scanning the entire market based on criteria you define.
Like what criteria?
You might set a scanner to alert you whenever a stock hits new highs or lows for the day and has high relative volume, say 1.5 times normal, and has a decent average true range, ATR, which measures its typical daily price movement. Maybe an ATR over 50 cents, ensuring it moves enough to be worth trading. These scanners flag opportunities as they develop in real time.
Got it. So you've built your watch list, maybe found a stock via a scanner, it looks like it's in play. Now you need to actually read the price action to decide precisely when to enter and exit. And the language the market speaks for this is candlesticks.
Candlesticks are the absolute foundation of reading price action, yeah? They're the building blocks of technical analysis for most traders.
And they originated way back, didn't they, with Japanese rice traders?
That's right. Legend attributes them to a trader named Hama back in the 17th century in Japan. And what makes them so powerful is how they visually represent the battle of psychology between buyers, the bulls, and sellers, the bears, over a specific time period, whether it's a 1-minute candle, a 5-minute, or a daily candle.
So looking at a candle tells you more than just the price.
Much more. It visualizes the sentiment, the story of that period. The main body of the candle shows you the range between the opening price and the closing price.
Right. Green if it closed higher, red if it closed lower.
Typically, yes. And then you have the wicks, or shadows, sticking out from the top and bottom of the body. Those show the absolute high and low prices reached during that period.
So a long green candle with tiny wicks means
the buyers were in complete control, almost from the open to the close. Strong bullish sentiment. A long red candle, conversely, shows strong bearish control.
Okay, those seem clear. But the sources highlighted certain candles as being particularly interesting. The indecision candles.
Yes. The indecision candles are critical because they often signal potential turning points, moments of exhaustion in a trend. These include patterns like spinning tops and especially dojis.
What makes them look indecisive?
They're characterized by having a very small or sometimes non-existent real body, meaning the open and close prices were very close together, but they often have long upper and lower wicks.
So lots of price movement up and down during the period, but ultimately it finished near where it started.
Exactly. It shows a fierce fight between the bulls and the bears, but neither side could gain control by the end of the period. It represents equilibrium, uncertainty, indecision in the market.
Why is that significant? Say, if a doji candle appears after a long, strong uptrend.
It's potentially very significant. That uptrend was driven by buyers being firmly in control. The appearance of a doji suggests those buyers might finally be getting exhausted. The sellers fought back hard, creating those long wicks, and managed to force a stalemate. It's a warning sign that the bullish momentum might be fading and a reversal could be coming.
And the same logic applies if a doji appears after a strong downtrend. Suggests the sellers might be running out of steam.
Precisely. It signals potential exhaustion of the prevailing trend. Now, and this is crucial, a doji, or a spinning top, by itself does not guarantee a reversal. It only indicates indecision.
So just trading every time you see a doji is a bad idea.
A very bad idea. You'll get chopped up. You need confirmation. Context is everything.
How do you get confirmation?
Candlestick patterns gain immense predictive power when they form at or very near critical, pre-identified technical levels on the chart.
Like support or resistance levels. Or maybe that VWAP indicator.
Exactly. Imagine you see a clear resistance level that the stock has failed to break through several times before. Now the price rallies up to that exact level again, and right there it prints a doji or a spinning top.
Okay.
That combination, the indecision candle forming at a known area of potential selling pressure, is a much higher probability signal that the rally might fail there, and the price could reverse lower. You're combining the candlestick psychological signal with the objective market structure. That's the essence of finding a high-probability trade setup like a classic top reversal or bottom reversal pattern.
Okay, that makes sense. Combining the candle signal with other confirming factors. Wow, this has been incredibly detailed. A real deep dive into a career that clearly demands immense preparation, discipline, and the right tools. Let's try to wrap this up with the most essential takeaways. What's the final message?
I think the biggest theme running through all the sources is that day trading is absolutely a marathon, not a sprint. And survival, let alone success, hinges almost entirely on discipline. Discipline in preparation, discipline in risk management, discipline in execution.
Yeah, and that idea you mentioned, that trading is a process-oriented pursuit,
Yeah.
like mountaineering or something. Focus on the climb, the steps, not just the summit.
Exactly right. You have
Yeah.
to religiously focus on your daily execution and sticking to your plan. Did I follow my rules today? Did I do my morning prep? Did I calculate my risk correctly in every trade? Did I honor my stops? You focus on that, not on the immediate profit and loss number on your screen.
Because paradoxically, a profitable day where you broke all your rules is actually a bad trading day, right? It reinforces bad habits.
It's terrible. It teaches you that gambling can work, which is lethal long term. Conversely, a losing day where you followed every single one of your rules perfectly, that's actually a good trading day. You
Yeah.
executed your process correctly. The outcome wasn't in your control, but your actions were. That's what builds consistency.
And that brings us back to that final, maybe uncomfortable truth about internal discipline.
Yeah.
You told that story about institutional traders, guys working at prop firms who are profitable there,
Yeah.
but then they leave to trade their own money from home and they fail almost immediately. Why does that happen so often? Why does that external structure matter so much?
Because that structure, the firm's strict risk rules, the manager breathing down their neck, it forces them to be disciplined. It takes the burden of personal accountability off their shoulders to some extent. The rules are imposed externally. When you go solo, become a retail trader at home, poof, that external manager is gone. All that responsibility for cutting the loss when you don't want to, for not averaging down when you're tempted, for hitting the sell hotkey instantly instead of hesitating and all fall squarely onto you, you have to build and enforce that discipline entirely internally. And that's incredibly hard for most people.
So if someone listening is thinking about this, contemplating this demanding career, how can they honestly assess if they even have that necessary psychological makeup, that internal fortitude?
Well, there's a saying, isn't there, that the highest measure of intelligence is the ability to change, especially changing your own ingrained habits and behaviors.
Okay.
So the sources kind of leave us with this final provocative thought to chew on. If you find you cannot consistently conquer relatively small bad habits in your regular life, maybe you can't stick to a simple exercise routine, or you keep failing to cut back on coffee or sugar, or you procrastinate constantly, then how, realistically, will you find the deep emotional and psychological strength required to rigidly stick to a stop loss when you're staring at a potentially catastrophic losing trade flashing red on your screen? The argument is, you probably won't.
So success in trading isn't just about learning charts. It's about actively working on yourself, on your personality, your self-control at every level.
That seems to be the deepest truth. Your biggest challenges, your most expensive failures in trading will almost always stem from psychological errors, from breakdowns in discipline, not from a lack of technical knowledge. You have to be willing to change and develop yourself constantly. It's as much a journey of self-mastery as it is market mastery. Welcome back to the deep dive. Today we are taking a deep breath and strapping into the cockpit of something pretty intense, day trading.
Yeah, it's definitely high stakes. And look, we're not talking about your long-term investments here,
Well-
right? This isn't about retirement funds.
No, exactly. This is, well, it's an aggressive short-term intraday business. It's all about trying to pull profits from tiny, quick market moves.
That's right. And the sources we're looking at today treat it like a serious profession. Think demanding, like medicine or law, requiring intense focus.
So it demands specialized tools, a very specific mindset, kind of detached maybe, and just absolute dedication to managing risk. Non-negotiable.
Totally non-negotiable.
Okay, so our mission today is basically to decode this whole system. We want to cut through the hype and figure out what really works, what are the core strategies, what's the actual step-by-step process a pro follows.
And what does it really take for someone new to find that elusive edge and, hang on to it in such a volatile place?
We're looking for the smart shortcuts, yeah, but also the harsh truths. No sugarcoating.
And we had to start with the big one, a really fundamental reality check. The data, including things like court records, analyzing new accounts, it paints a pretty brutal picture.
How brutal.
Well, one study from Massachusetts showed that after just 6 months, only about 16%, 1/6 of new day traders actually made any money.
Wow, 16%. So you're looking at an 84, maybe even 90% failure rate for people starting out.
That's the ballpark, yeah. Which brings us straight to Andrew's rule number 1, a concept that pops up everywhere. Day trading is absolutely not a get-rich-quick scheme.
Right. If you walk in thinking you'll make thousands easily, you're just funding the traders who take it seriously.
The market will happily take your money, yes. And that leads directly to rule number 2. Day trading is not easy. It has to be treated like a proper business.
Requires study, preparation, and crucially, keeping your emotions in check. I mean, you wouldn't expect a $200,000 a year job to be easy, right?
Exactly. Think about who you're up against.
Yeah, if you just roll out of bed at 9.25, glance at your phone, place a trade, you're competing with institutions, with million-dollar algorithms.
People who studied this for years. So preparation isn't just recommended. It's basically essential for financial survival.
Okay, so the stakes are clear. High risk, high difficulty. Where do we start decoding it?
Well, the journey today starts with the absolute foundation: discipline and risk control. Then we'll look at the tools and the right targets, which stocks to even consider.
Got it. Then strategy.
And the strategies, yeah. We'll break down 4 key ones, and finally we'll walk through the actual process step by step and look at a really interesting case study of someone who found their own way.
All right, let's dive into that foundation. You mentioned a 3-legged stool.
Yeah, it's a common analogy in the sources. Success rests on 3 legs. Technical knowledge, that's knowing your strategies, your charts. Then proper risk management, protecting your capital.
And the third?
Sound psychology, controlling your emotions. And here's the thing. You take away any one of those legs.
The whole thing collapses.
Exactly. Beginners often obsess over the technical stuff, the strategies, but honestly, most failures, maybe 90%, happen because of weak risk management or letting emotions take over.
That psychological leg seems like the trickiest one. One source puts it bluntly: profitable trading must not involve emotion. You got to be calm, cool, and collected.
Which is incredibly hard, right?
Oh.
You see thousands flashing on the screen going up or down in seconds.
Yeah.
The natural human reaction is panic or greed or fear.
So how do you cultivate that calm? It sounds like it needs serious self-discipline.
It does. And crucially, this is internal discipline, not like having a boss breathing down your neck. The sources link it directly to your everyday habits.
Like what?
Like, can you actually stick to a routine? Can you make yourself go for that run every morning before the market opens? Or can you stop yourself from constantly checking Twitter when you know you shouldn't?
Interesting. If you can't manage yourself in low-stakes situations.
You probably won't have the mental strength when thousands of dollars are potentially on the line. It just won't happen.
Okay. Discipline is key. That flows right into the next pillar. Risk management. Rule 5, I think.
Right, rule 5. Success fundamentally comes from risk management. It's about finding low-risk entries that have a high potential reward. It's less about being a perfect predictor.
And more about managing the times you're inevitably wrong.
Precisely. And a key part of that is the win-loss ratio. You need a minimum acceptable ratio of 2 to 1.
Meaning?
Meaning if you risked, say, $100 on a trade based on your setup, your potential profit target needs to be at least $200 if the setup doesn't offer that potential.
You just skip it, even if it looks tempting.
You skip it. By definition, it's a poor risk-reward setup. You have to be that disciplined.
And the ultimate safety net seems to be the 2% rule.
Ah, yes, absolutely critical. Never, ever risk more than 2% of your entire account balance on any single trade. Full stop.
Why is that so important? It sounds maybe a bit conservative.
It's about survival. Let's say you have a $50,000 account. 2% means your maximum risk on one trade is $1,000. Now imagine you risk 10%, instead $5,000. It only takes 10 losing trades in a row to completely wipe you out. And believe me, 10 losses in a row can happen fast.
Whereas with the 2% rule,
you could withstand 50 consecutive bad trades before blowing up. That buffer, that ability to survive losing streaks, that's essentially your education fund. You pay for lessons with small losses, not your whole account.
Got it. So how do you actually apply that 2% rule in the heat of the moment? There's a 3-step method mentioned.
Yes, a very specific calculation you must do before placing the trade. It takes the emotion out of deciding your position size.
Okay, walk us through it. Step 1.
Step 1 is easy. Calculate your maximum dollar risk. That's just 2% of your account. So $50,000 accounts, that's $1,000 max risk.
Step 2.
Step 2 is market-driven. Estimate your risk per share. This comes from your technical analysis. Where's your stop loss going to be relative to your entry price?
So if I buy at $10 and my chart says the trade is bust if it drops below $9.60.
Then your risk per share is 40 cents. Simple subtraction.
Okay, max dollar risk per share. Step 3.
Divide step 1 by step 2. Max dollar risk divided by risk per share. Let's use their example. A smaller account, say $20,000. Max risk is $400. 2% of 20K. Your risk per share is still 40 cents.
So $400 divided by $0.40.
Equals 1,000. That means for that specific trade setup, the absolute maximum number of shares you are allowed to buy is 1,000.
You could buy fewer, but never more.
Exactly. It replaces guesswork or greed with cold, hard math. You know your max size before the trade even happens.
Speaking of greed and emotion, we need to talk about averaging down. It sounds like a cardinal sin for beginners.
Oh, it's incredibly dangerous. Averaging down is when you're in a losing trade and you buy more shares at a lower price, just hoping to lower your average cost so you can get out at break even easier.
It feels intuitive, maybe, like you're getting a better price.
It feels intuitive, but it's pure hope replacing strategy. And the sources are honest. Look, it might even work maybe 85% of the time, especially if the market's generally going up.
Which gives you false confidence.
Massive false confidence. Because it's that other 15% of the time. That one time it doesn't bounce back. That's when it destroys accounts. Catastrophically.
Just takes one unexpected event, right? Bad earnings, some crisis.
Exactly. That manageable loss suddenly becomes an account-ending disaster. The source mentioned a trader losing $25,000 on American Airlines because he ignored his plan and just hoped for a government bailout. That's averaging down logic.
So the advice is just never do it as a beginner.
Strongly advised, never. The psychological lesson here is maybe the hardest.
Yeah.
You have to learn to be a good loser.
Meaning accept small losses quickly.
Yes. Your job isn't to be right all the time. Your job is to make money by following your plan. That means taking small hits, maybe just a few cents per share, 1 cent, 10 cents, 30 cents the moment the trade proves you wrong. Get out. Losing is just a cost of doing business.
Okay, mindset locked, risk managed. Let's move to the battlefield itself, finding the right targets. The sources emphasize only trading stocks in play. What exactly does that mean?
Right. Rule 7. This is critical. In play means a stock is moving independently of the overall market, like the S&P 500, and even its own sector. It's doing its own thing.
Why would it do that?
Because it has a specific fundamental catalyst. Unexpected fresh news, a surprise earnings beat or miss, a merger, a big FDA drug approval. Something specific to that company is driving intense interest right now.
So it's not just any volatile stock.
No, definitely not. And the second key ingredient is volume. It needs high relative volume, meaning it's trading way more shares today than it normally does.
Why is that important?
High relative volume suggests that retail traders, driven by that news catalyst, are dominating the trading. If the volume is just average or low, the price action is likely controlled by big institutions and high-frequency trading algorithms.
And retail strategies don't work well against those.
Not consistently, no. You get chopped up. That's why you generally avoid stocks that trade less than, say, 500,000 shares a day on average. You need liquidity and retail interest. These are the alpha stocks where retail can have an edge.
So where do you find these stocks in play each morning? It sounds like a filtering process.
It absolutely is. Starts with two main methods. First, pre-market gappers. Before the market even opens at 9:30 a.m. Eastern, you're looking for stocks that have already gapped up or down significantly, maybe 2% or more.
And showing unusual activity before the bell.
Exactly. High pre-market volume compared to its norm. Traders often start super early, like 6 a.m., scanning potentially hundreds of these gappers.
Hundreds, wow.
Yeah, but you have to ruthlessly filter them down.
Yeah.
Based on the clarity of the catalyst, the volume, the price range.
Yeah.
You want maybe just 2 or 3 top candidates for the open, your prime watch list.
Okay, pre-market scan. What's the second method?
Real-time intraday scans. These run during the trading day, looking for setups that develop after the open, like momentum or reversal plays.
What are these scanners looking for specifically?
They're typically set up to find stocks with decent volatility, like an average true range or ATR, over 50 cents. You need enough movement to make a profit, right?
Makes sense.
And again, relative volume. Usually looking for at least 1.5 times its normal volume. If a stock hits those scan criteria during the day, it signals there's enough interest and fuel for a potential trade.
Got it. So you found your targets. Now infrastructure. Speed is key, you said. What kind of broker do you need?
You absolutely need a direct access broker. Forget the full-service guys who offer research reports. You need speed and flawless execution above all else. The broker needs to send your order directly to the exchange, like NASDAQ or NYSE, instantly.
Interactive brokers, IBKR Pro, gets mentioned often.
Yeah, IBKR is a very common choice for active traders, precisely because of its speed, reliability, and direct access routes.
Now, this brings us to something tricky, the PDT rule, the pattern day trade rule. Can you explain that?
The PDT rule, yeah.
Sure.
In the U.S., if you make 4 or more day trades, that's buying and selling the same stock within the same day, within a rolling 5 business day period, you get flagged as a pattern day trader.
And the consequence?
You have to maintain a minimum account equity of $25,000. If your balance drops below that, your account gets restricted from further day trading until you bring it back up.
Okay, but I'm kind of struggling with the logic here. It's supposed to protect amateur traders, right, from blowing up small accounts.
That's the stated rationale, yes, to prevent undercapitalized traders from taking excessive risks, especially on margin.
But requiring $25,000, doesn't that just lock out most people who might want to start small and learn? It seems counterintuitive if protection is the goal.
It's a long-standing debate, honestly. It certainly creates a significant barrier to entry. It was implemented partly to protect the brokers, too, from margin calls on small, volatile accounts.
So what do people under 25K do?
Well, some traders look to offshore brokers. They aren't regulated by FINRA in the U.S., so they don't enforce the PDT rule. But, and this is a major caveat, the risks are significantly higher. Less regulatory oversight, less protection if the broker goes bust. You need to be extremely careful.
Okay, so assuming you have the account sorted, let's talk execution speed. Hotkeys seem non-negotiable.
Absolutely critical. Profitable day trading, especially fast strategies like ORB, is almost impossible without them. A setup can appear and hit its profit target in literally seconds.
No time to click around with a mouse.
None. You need Hotkeys custom keyboard shortcuts programmed to execute complex orders instantly. Like Alt+1 buys 500 shares at the asking price plus 5 cents immediately. It has to be muscle memory.
That millisecond difference matters.
It's often the difference between getting filled at a good price on a breakout or chasing the move after it's already happened and getting a terrible entry. Speed is edge here.
And the type of order you send? Market order.
Limit order?
Neither, ideally. The preferred tool is the marketable limit order.
Okay, explain that hybrid. A normal market order buys instantly, but at whatever price is available, right? Risk of slippage.
Exactly. You get speed, but maybe a bad price if things move fast. A normal limit order guarantees your price or better, but you might not get filled at all if the price moves away too quickly.
So the marketable limit order, it's like saying, buy me right now, like a market order, but I refuse to pay more than this specific price. You set a small cap, maybe a few cents above the current ask. It gives you the speed you need, but limits the potential damage from slippage. It's smart risk control built into the order itself.
Makes sense. Lastly, infrastructure-wise, Level 2 data, mandatory.
For U.S. markets, yes, absolutely mandatory for serious traders. Level 2 is your window into the order book. It shows the bids, who wants to buy, at what price, how many shares, and the asks, who wants to sell.
And why is that a leading indicator?
Because it shows intention before the trade actually prints on the chart. Charts are lagging and they show what has happened. Level 2 shows what people are trying to make happen right now.
So you can see big buyers or sellers lining up?
Precisely. If you see a huge buy order suddenly appear on the bid side right below the current price, that's a strong signal that support might hold, or a breakout might be imminent. It gives you clues that chart-only traders don't see until it's too late.
Okay, foundation, tools, targets. Now the exciting part, the strategies, the arsenal. You said they need to be simple and personalized.
Yes, absolutely. And practice relentlessly in a simulator first. Don't try this with real money until you've proven consistency. And the type of strategy often depends on the stock itself.
Based on float and price, why does that matter so much?
It dictates the stock's personality, its volatility. Low float stocks, say under 20 million shares available, especially those under $10, they can be incredibly explosive. They can move 100%, 200% in a day.
So different rules apply.
Definitely. The sources strongly advise using only momentum strategies on these and only going long. Trying to short sell a low float stock is incredibly dangerous for a beginner because the risk of a massive short squeeze is just too high. You could lose way more than your initial investment.
Okay, so low float under $10 equals high risk momentum, long only. What about others?
Medium float stocks, maybe in that $10 to $100 range, often with higher floats, tend to be where the core strategies we're about to discuss work best. They usually have enough volatility for opportunities, but also enough liquidity to get in and out cleanly.
All right, let's get into those core strategies. First up, VWAP trading. Strategy 6. What's VWAP?
VWAP stands for Volume Weighted Average Price. It's arguably a single most important indicator for day traders. Unlike a simple moving average that just looks at price, VWAP incorporates the volume traded at each price level.
So it tells you the average price paid, weighted by how many shares actually traded there.
Exactly. It's a benchmark used heavily by institutions. They often measure their own trading success by whether they bought below or sold above the day's VWAP.
How does a retail trader use it then?
It acts like a dynamic line in the sand for control. Generally, price trading above VWAP suggests buyers are in control for the day. Price trading below suggests sellers are dominant.
So the trade is based on how the price reacts to VWAP.
Pretty much. A common setup is to watch the stock after the initial open volatility. If it pulls back and tests the VWAP line and finds support there, buyers step in strongly right at the VWAP. That can be a good long entry signal. You're trading with the perceived institutional flow.
And the stop loss, where do you get out if it goes wrong?
Typically, a common stop is if a 5-minute candle closes decisively below the VWAP line. That signals that support has failed, sellers have likely taken control, and you get out with a small, defined loss.
Okay, VWAP testing. Next up sounds trickier. Reversal trading, strategies 3 and 4. This is like trying to catch a top or bottom.
Exactly. It's often called catching a falling knife or shorting a rocket ship. Because of that, it requires extreme caution and very specific confirmation. You're betting against the current powerful trend.
What needs to align for this setup?
3 main things usually. First, the stock needs to be clearly extended, like maybe 5 or more consecutive 5-minute candles, all moving strongly in one direction, all green or all red. Second, an indicator like the Relative Strength Index, RSI, should be at an extreme, very overbought, like above 90 for a short setup, or very oversold, like below 10 for a long setup.
And third, this sounds critical.
Third, the price needs to be stalling near a pre-identified significant support or resistance level, a level that caused bounces before, or a major daily level.
Okay, extended extreme RSI at a key level. Is that enough to jump in?
Absolutely not. That's the setup. The confirmation is crucial. You must wait for an indecision candlestick to form right at that level. Like a doji, a spinning top, a hammer, something that shows the powerful trend is pausing, buyers and sellers are fighting.
That candle signals exhaustion.
Right. Then and only then do you consider an entry. The entry trigger is usually the next candle making a new high, if you're trying to catch a bottom reversal, or a new low, if you're trying to short a top reversal. You need proof the reversal has actually started.
And the stop loss is tight.
Very tight. Usually just below the low of that indecision candle for longs, or just above its high for shorts. Or if the key support resistance level is clearly broken, risk has to be minimal because you are fighting the prevailing momentum.
Okay, that one needs serious patience. What about support or resistance trading, strategy 7? Sounds related, but maybe less aggressive.
It is related, but generally considered more reliable because it aligns with a well-known market behavior. Support is simply a price level, where past selling pressure dried up and buyers stepped in. Resistance is the opposite, where buying dried up and sellers took over.
And these levels work because everyone sees them.
Largely, yes. It becomes a bit of a self-fulfilling prophecy.
Right.
Traders identify these levels maybe a previous day's high or low, a round number like $50, a major moving average, and they tend to place orders around them. Buyers buy near support, sellers sell near resistance.
So the trade is similar to the reversal, but maybe less extreme conditions are needed.
Kind of. You're still looking for the price to approach a known level. Again, you ideally want to see some confirmation that the level's holding maybe an indecision candle forms at the level.
And then you enter.
Then you enter, trying to get as close to the support line for a long, or resistance line for a short as possible. This minimizes your risk because your stop loss goes just on the other side of that level. If the level breaks cleanly, you're out fast.
Maximum reward for minimum defined risk. I see the pattern. Okay, last one. Opening range breakouts. ORB, strategy 9. This sounds like pure chaos trading.
It focuses on the first few minutes after the 9:30 a.m. Eastern Open, which is typically the most volatile period of the day. Massive volume, big price swings. It can be chaotic.
But wait, we just talked about being calm and collected. How does a trader handle this violent price action?
That's the key. The professional finds calm within the chaos by being disciplined about when they act. The mistake novices make is jumping in during the first 30 seconds, trying to guess the direction.
So what does the pro do?
They wait. Specifically, many ORB strategies involve waiting for the first 5 minutes to complete. Let that initial chaotic battle between overnight holders and new buyer-sellers play out and establish a clear high and low price for that opening 5-minute period. That's the opening range.
Ah, so you wait for the dust to settle slightly and define a range.
Exactly. Then the trade is simple. You enter in the direction the price breaks out of that 5-minute range. If it breaks above the 5-minute high, you go long. If it breaks below the 5-minute low, you go short.
What's the logic?
The logic is that the break signifies which side buyers or sellers, has won that initial battle, and you're jumping aboard the expected continuation of that momentum.
Stop loss.
Usually placed just on the other side of that 5-minute range. So if you go long on a break above the high, your stop is just below the low of that range. Or sometimes VWAP can act as a trailing stop. It's fast, but the entry and exit points are clearly defined by that initial range.
Okay, those are some concrete strategies. But knowing them isn't enough, right? It's about the process, the routine.
Absolutely. Transitioning from theory to consistent profit is all about process and practice. And the first part of that is understanding the time of day matters.
Not all strategies work equally well all day.
Definitely not. Experienced traders track their performance and know when their edge is strongest. Statistically, the open, roughly 9:30 a.m. to 10:30 a.m. ET, is prime time. Highest volatility, highest liquidity. Perfect for those ORB, momentum, and initial VWAP tests.
Then things slow down.
Yeah, then you often hit the midday, maybe 12:00 p.m. to 3:00 p.m. ET. The sources call this the most dangerous time. Volume dries up, liquidity thins out. Stocks can get really choppy and make unexpected moves on low volume.
So, caution advised.
Big time. If you trade midday, you generally need to reduce your share size significantly. Focus only on A-plus setups, often reversals or maybe support resistance plays if they appear. Honestly, many pros just step away during these hours. It's not worth the chop.
Okay, so timing matters. What about the daily routine itself? It sounds rigorous.
It has to be. Rule 2 again. Treat it like a serious business. The routine often starts way before the market opens. Waking up early, maybe exercise, shower, get dressed properly.
Even if working from home.
Especially if working from home. It sets a professional mindset. Then, starting that watch list preparation by 6 best or 7 a.m., reviewing the gappers, reading the news catalysts behind them, checking volume stats, ATR.
And the crucial part is planning before the chaos starts.
Absolutely. Before 9:30 a.m., you must have clear if-then scenarios written down for your top watch list stocks. If stock XYZ breaks $50.50 with volume, then I will buy X shares with a stop at $50.20. The plan is made when you're calm and rational.
Then when the market opens and your trigger hits.
You execute without hesitation, no second guessing. Your focus shifts entirely to executing the plan, hitting your predefined profit targets, and honoring your stop loss.
And that tip about hiding your P&L?
Yeah, really good advice for beginners. Watching the dollar amount fluctuate just triggers fear and greed. Hide it. Concentrate solely on making a good trade according to your plan. Did you enter correctly? Did you manage the stop correctly? That's the focus.
Makes sense. But obviously you won't execute perfectly at first. This is where the simulator comes in.
Mandatory. Paper trading in a simulator is non-negotiable for new traders, typically for at least 3 to 6 months. And it has to be realistic.
Meaning?
Meaning you need real-time market data, which often isn't free, maybe costs $100 a month or so. And critically, you must trade with the exact same share size in the simulator that you plan to use when you go live.
So if you plan to trade 100 shares live, you practice with 100 shares simulated.
Exactly. Practicing with 10,000 shares when you only have capital for 100 is useless. It doesn't prepare you psychologically for the real risk. This simulator period, doing it properly, that is your tuition fee. Much cheaper than losing real money.
And the goal during simulation isn't make fake money.
No. The goal must be process-oriented. My goal is to follow my ORB entry rules perfectly 10 times. Or, my goal is to manage my stop loss correctly on every trade this week. Focus on executing the process well, not the outcome.
And doing this alone sounds tough. Community helps.
Hugely important. Trading can be incredibly lonely and emotionally draining. Joining a reputable trading community provides mentorship, accountability, sharing your trades with others, and just the comfort of seeing that, hey, even experienced, profitable traders have losing days. It normalizes the losses.
That leads perfectly into the case study mentioned, John Hiltz. He struggled initially.
Yeah, great example. John came from the Army, read all the books, knew the technicals, but failed live at first. Why? Because he was trying to copy other people's strategies that didn't fit his personality or risk tolerance.
What was his turning point?
Self-awareness. He realized, okay, I'm actually pretty good at spotting these quick, sharp runs, but I'm terrible at predicting when they'll reverse. He needed a strategy with almost zero ambiguity.
So he developed his own.
Exactly. He focused almost exclusively on what he called the break of high of day trade, or BHOD.
Break of high of day? How did he define the entry to make it unambiguous?
This is clever. He didn't just wait for the price to tick above the day's high. He watched the level 2 data, and he entered aggressively the instant the B/D price broke the previous high of day print.
The bid. meaning a buyer was actively offering to pay more than anyone had paid all day.
Precisely. That showed aggressive buying intent. Confirming the momentum as it happened, it removed the guesswork. That specific level 2 signal was his edge.
And how did he manage the trade?
Aggressively, but smartly. He'd take partial profits quickly, often selling maybe half his position at the next key psychological level, like a $half or whole dollar mark, $50.50, $51, etc.
And crucially,
the moment he took that first partial profit, he immediately moved his stop loss on the remaining shares up to his original entry price break-even.
Locking in profit and removing risk on the rest.
Exactly. Secure some gains, then ensure the worst outcome for the rest of the trade is scratching it for zero profit or loss. Classic professional risk management.
The Disney example illustrated this well, right?
Perfectly. He saw DIS setting up, identified the high of day. When the bid broke $113.53, he jumped in long, took his first partial profit, near $114, maybe 50% of his shares, immediately moved his stop on the rest to $113.53.
So he banked profit and the rest was a risk-free trade.
Risk-free in terms of capital loss, yes. He was safe from a sudden reversal, wiping out his gains. That's trading well.
The big lesson from John seems to be, find your own thing.
Absolutely. You have to develop your own playbook. Find a setup, an edge that resonates with your psychology, your strengths, your risk tolerance. Then, and this is important, give it a name like DHOD. Own it. Track its performance meticulously. Is it consistent? When does it work best? That's how you build confidence and mastery.
Okay, so let's try to synthesize this. We've covered a lot. What are the absolute core takeaways for someone listening, thinking about starting this journey?
Well, it really boils down to those 3 pillars again. First, internal discipline. You have to be your own toughest boss. The sources mention how some successful traders at prop firms fail when they go independent because that external accountability disappears. You must build it internally.
Second, rigorous risk management. That 2% rule is your lifeline. That minimum 2.1 reward to risk ratio on setups is your filter. If you don't know exactly where your stop loss is before you enter, you simply don't enter the trade, period.
And third, finding and refining your personal edge, like John Hiltz did. It might be VWAP bounces, it might be 5-minute ORBs, it might be something unique you discover through practice. But you need a specific, repeatable setup that you understand deeply and can execute consistently.
And how do you refine that edge? How do you improve day after day?
Through relentless reflection and review. This is maybe the most crucial part of the long-term journey. Keeping a detailed trade journal every single day is essential.
And not just P&L, right?
Oh, much more than P&L. You need to journal your mental and physical state. Did you sleep well? Are you stressed? Focused? Then grade your execution. How well did you follow your entry rules? How well did you manage the stop? Did you stick to your checklist?
Like athletes watching game film.
Exactly like athletes watching film. Some traders even video record their screen while trading and review it later. You have to diagnose why you took a loss. Was it a bad stock pick? A sloppy entry? Or the most common culprit? Did you fail to honor your stop loss due to fear or hope? Discipline failure.
Without that detailed review, you just repeat the same mistake.
You're doomed to repeat them, yes. The journal is where the learning happens.
So ultimately, success here isn't about genius predictions. It's about process.
It's entirely about being process-oriented, not result-oriented. Forget dreaming about making $1 million. Focus obsessively on executing your plan perfectly on the very next trade. The results will eventually follow the process.
Which brings us to our final thought for the listener, something to maybe chew on.
Yeah, there's a quote, something like, "The measure of intelligence is the ability to change." Day trading forces you to confront your habits, your discipline, your emotional control, perhaps more intensely than anything else.
So the question is,
if you're genuinely serious about trying to succeed in this extremely challenging but potentially rewarding field, are you truly willing to do the hard work of changing yourself? Changing those ingrained habits, procrastination, impulsiveness, poor routines that will directly impact your ability to follow your rules when real money is flashing on the screen.
Yeah.
That's the fundamental question. Are you willing to change?